Yes, it is that time again. Usually Craig and I have a chat, about 11, 12 o'clock actually. But he has very kindly consented to join us early this morning because, well, we're doing breakfast, so here we go. And he joins us now. Craig, welcome to the show, mate.
Thank you very much. How are you, Michael?
I'm well. Hey, listen, just before anything else, the interest rates have been one of the reasons why people are complaining about, and understandably so, the cost of living at the moment, home mortgage rates. You've suddenly got less money in your weekly pocket, but also businesses, the cost of capital, etc. The inflation rate came in this week. It's dropped to 3.3%, which I think was a little under the expectation of the Reserve Bank. Does that mean that we might finally get an easing of monetary conditions?
Well, the answer is yes. The question everyone's trying to figure out is when. You're right about the RBNZ expected 3.6, and the number came in at 3.3%, which is lower than the March quarter annual number. And, you look at the components of that increase of 3.3, Michael. They're the old hoary contributors. Rent was up 4.8%. New house construction +3 rates. Your neck of the woods, 9.6%. And insurance, 14%. So when you break down what caused the shift from the last quarter to this quarter, the real contributor was the tradables inflation. So that's sectors of the economy that are exposed to competition, and that fell from 1.6% last quarter to 0.3%. That's quite a big shift down. But your tradable sector, those contributors I just mentioned, only fell from 5.8 to 5.4. So, yes, there's an expectation because the markets have already moved. Mortgage rates have come off slightly, like 20 basis points, from 7 to 6.8% for 1 year, roughly speaking. But does that really shift the dial for a mortgage borrower, that amount of change? Maybe it's a market share grab by the banks concerned. I don't know. They've all got their own books and profitability targets, etc. So, yes, the question on the table is that a November interest rate cut at the very short end of the interest rate curve in terms of short-term interest rates, or is it later, such as early next year? In any event, the market's already moving in anticipation of that. So deposit rates and mortgage rates are already moving. Whether they will continue to do will be subject to information that comes out. I quite like looking at the gdplive.net website, and that's a live forecast of GDP and inflation, and they're not picking any change in the OCR at the moment based on current information. So, markets can move around quite a bit. They can, get quite bullish about things and drop rates, or they can hold things. So we'll just see how things pan out. There's just a couple of cautions I want to make. I've spoken about this before. The RBNZ has quite clearly expressed their concern about our low productivity trajectory, and have therefore got a lower GDP number at which point they will raise rates. So whereas, just take by way of example, if GDP was 4% before and they raised rates, now they might raise rates if it was 3.8% by way of an analogy. So there are lower thresholds now for raising rates because of that poor productivity outlook, and they've also raised their OCR long-term trend. So it might well be that expectations are for lower rates, but they may not go down that far, is my caution.
Yeah, I mean, it's been a tough year. It's a grim year, I have to say, not just in terms of cost of living, but for any business doing business in New Zealand. When would you expect, and as you know, you would have heard the maxim, we've talked about it, and, just survive until 25. When would you expect, Craig, I mean, you're gifted in this area, there to be an upturn in economic conditions in this country? Will it happen next year?
Well, it's kind of a crass statement in some respects, Michael. I mean, these sorts of pressures have impacts on value, in particular asset values, and you've seen the impact on house prices, for example. You're certainly seeing it in other sectors of the economy where asset prices and opportunities have to get better to justify borrowing, right? When you look at a project, you have to build in the the costs of financing a project, and they've been an enormous contributor to why consents, construction, etc., are faltering because of the cost of finance. If that stays up for a longer period of time, then activity will happen if asset prices fall, and you can start from a lower base. And I think that's still not shifting through enough into, people's decisions around what they do. Hanging on might not be the best strategy.
Well, what do you mean? We don't hang on?
What I mean by that is that if I think interest rates can come down as a strategy of hope, I'm not sure hope is a great strategy. In some senses, adapting by cutting positions or cutting your holding and refocusing on something else may be better. I think a strategy of expecting your position to get better with falling interest rates when things have changed underneath, I'm not sure is the right strategy. I'm just saying interest rates may not fall as quickly and as far as people may expect. Certainly, by just looking back in the last 3 years, it's very difficult to see rates come down as low as they did in 2020, 2021.
Right. So, okay. Let's just go through that again. So if economic conditions, they're not depressed at the moment, but...
well, they're flat, aren't they? They're flat.
Are. Yeah. I mean, if it's under 3%, then we're not really getting real growth in the economy, are we? So I've just looked at your GDP Live. They're predicting, 0.7%? So it's what? Is that right? That's what they determine GDP growth? Yeah.
Yeah, but basically flat.
That's right. So if that's the case, and retailers, businesses, anybody in the commercial sector, small businesses in particular, are experiencing tough conditions and hoping that next year will deliver some form of relief, your argument is you need to actually look at the structure of your business because hope isn't the strategy.
Yep, you've got to cut costs. You've got to find other ways of eking out a better margin, focus on your customers, look for new revenue streams. You can't sit still and hope that interest rates fall. They may well do, but they may not fall enough to improve your profitability is what I'm saying.
The agriculture sector is slightly different in the sense that they are very much based upon commodity prices and the international markets, Craig. How are they going? I mean, I've heard nothing but bleakness from the sheep and wool sector at the moment, but elsewhere?
Well, I think other sectors like horticulture, I think in general is doing pretty well. It's subject to how you fared during the floods, the disastrous floods in Gabriel, etc. Dairy, I think, is okay, subject to debt levels, for example. Although I'm always cautious about the reliance on China, and I think I've expressed this view before. But beef and wool definitely an issue. Forestry depends on what your particular business model is, but that may well be an area that is okay. I don't know enough about forestry per se. So, concerning thing for me is there's a volume question there. Are we able to sell more? But as always the case, it's the terms of trade. It's the price we get for our exports that really matters. So. We're not in boom times in pricing at the moment for sure. So, as a receiver, a price taker, New Zealand just accepts global prices, and so we have to adjust underneath. If we can't get the prices we used to have, we have to think about different business models again, and volume. Can we increase their volume with the same amount of costs to get a better revenue stream?